We are often told that the sun never set on the British Empire, but the ledger books of 1945 suggest a much darker reality, that by the time the victory parade started, the empire was already a foreclosed property. While the world cheered for the fall of Berlin, the British Treasury was quietly calculating the cost of a victory that had rendered them insolvent. Winston Churchill, the face of imperial defiance, found himself in the position of a CEO presiding over a forced liquidation. This was not a story of decolonization driven by conscience. It was a story of a sovereign debt crisis where the collateral was a quarter of the globe. The United States did not just win the war alongside Britain. It purchased Britain's entire global infrastructure for cents on the dollar. The math of the transition was cold, the terms were non-negotiable, and the first payment was due before the ink on the surrender papers was even dry. The British Treasury in 1945 was a graveyard of balance sheets and broken projections. While the public celebrated, civil servants were staring at a debt-to-GDP ratio that exceeded 250%. This was not a temporary dip in the business cycle, but a structural collapse of the entire imperial business model. Britain had sacrificed its role as the world's banker to fund a war of survival against an industrial juggernaut. Every bomb dropped over the Ruhr Valley was essentially a debit entry against the future of the British working class. This insolvency meant that the empire no longer functioned as a wealth-generating machine, but as a liability that required immediate restructuring. The only entity with the liquidity to prevent a total domestic crash was the United States Treasury. The transition from global hegemon to a debt-ridden client state was a calculated process of asset stripping. The American leadership understood that the war provided a unique opportunity to rewrite the rules of global trade. By providing the necessary materials for war, the United States could demand the dismantling of the British trade barriers that had locked American goods out of sterling markets for decades. This was not a collaborative effort between equals, but a hostile takeover of a failing conglomerate. The British government was forced to choose between total military defeat and a financial surrender that would end their global dominance. Britain was about to find out that the price of being saved was the loss of everything they owned. The liquidation began in earnest during the summer of 1940, long before the first American soldier landed in Europe. Britain faced a liquidity trap of existential proportions as the Nazi war machine consolidated its hold on the continent. To keep the assembly lines in Detroit and Pittsburgh moving, the British government had to pay in hard currency or bullion. This cash-and-carry policy was a brutal extraction of British capital reserves, leaving no room for credit or diplomatic leverage. By June, the situation was so dire that the government initiated a secret logistical operation to move the nation's entire wealth across the Atlantic. This was the moment the physical reality of British power began to evaporate. Known as Operation Fish, this massive transfer involved moving billions of dollars in gold and securities from the vaults of London to the relative safety of Canada. Warships and merchant vessels were packed with crates of bullion, slipping past U-boat wolf packs in a desperate bid to preserve the empire's remaining solvency. This was not a strategic redeployment of assets, but a frantic attempt to keep the lights on in Whitehall. Once the gold arrived in Ottawa, it was immediately liquidated to settle mounting invoices from American munitions manufacturers. The British public remained unaware that their national wealth was being drained at a rate that made long-run recovery impossible. This massive outflow of gold signaled the end of London's status as the global center of finance. Beyond the gold reserves, the British government was forced to sell off its private corporate holdings at fire sale prices. American investment banks hovered over British-owned American companies, waiting for the Treasury to order their divestment. One example was the forced sale of the American Viscose Corporation, a highly profitable British asset that was sold for a fraction of its book value to satisfy American political demands. These were not voluntary market transactions. They were forced liquidations required to prove that Britain was truly exhausted before more aid would be granted. The revenue from these sales was immediately recycled back into the American defense industry, creating a circular flow of wealth that benefited the U.S. economy exclusively. The empire was now operating on a deficit that no amount of colonial taxation could fix. By the end of 1940, the British treasury was effectively empty, and the nation was technically bankrupt. The cash and carry era had achieved its objective of stripping Britain of its liquid capital. Churchill famously warned President Roosevelt that the moment was approaching when we should no longer be able to pay cash for shipping and other supplies. This admission of insolvency was the green light for the United States to shift from a supplier to a creditor. The power dynamic had shifted permanently, and the terms of the next phase of the war would be written in Washington. With the vaults empty, London had to sign a contract that would effectively hand the keys of the global economy to Washington. When the gold ran out, the United States introduced a new financial instrument that would eventually strip Britain of its geopolitical autonomy. Lend Lease is often remembered as a generous act of democratic solidarity, but for the British Treasury, it was a high-interest mortgage on their sovereign future. The United States government was not interested in charity. It was interested in securing the post-war economic order. By providing weapons and supplies on credit, Washington gained unprecedented leverage over British domestic and foreign policy. This leverage allowed American negotiators to dictate terms that would systematically dismantle the British trade system. The price of survival was the surrender of the very mechanisms that made the empire profitable. One of the most lopsided transactions in history was the Destroyers for Bases Agreement, where Britain traded long-term leases on strategic territories for 50 aging warships. These vessels were largely obsolete, yet the United States secured 99-year rights to build military installations across the Caribbean and the Atlantic. This was a classic asset for debt swap, where a desperate seller is forced to part with high-value real estate to meet immediate operational needs. The U.S. military effectively moved into the British backyard, establishing a permanent presence that London could no longer afford to maintain. This deal signaled the beginning of the end for British naval supremacy and the rise of American global policing. Beyond physical territory, the U.S. targeted the Imperial Preference system, which had long protected British markets from American competition. Article 7 of the Lend Lease Agreement was the most lethal clause for the British Empire's economic future. It specifically demanded the elimination of discriminatory trade practices, which was a direct assault on the sterling area's protected markets. The United States wanted an open-door policy that would allow American corporations to dominate global trade without facing British tariffs. For London, this meant the end of the captive markets that had provided a steady flow of raw materials and wealth for centuries. The British negotiators knew that accepting these terms would lead to the eventual dissolution of the empire, but they had no alternative. The United States was not just funding a war, it was financing a competitor's bankruptcy. The American strategy was to ensure that Britain remained strong enough to fight the war, but too weak to challenge American commercial interests afterward. This required a delicate balance of providing enough supplies to prevent a British collapse while simultaneously draining their financial reserves. Every shipment of tanks or aircraft came with a long-term cost that would be extracted from the British taxpayer for decades. The British government was essentially borrowing its way into obsolescence. This was a masterclass in fiscal leverage, where the creditor dictates the internal policy of the debtor under the guise of mutual defense. The debt was not just financial, it was structural. As the war progressed, the British economy became entirely dependent on the American supply chain. This dependency meant that any attempt to assert British interests on the global stage could be met with the threat of a credit freeze. The American State Department used this leverage to ensure that the post-war world would be built on the dollar, not the pound. The British were no longer partners in a global enterprise. They were middle managers overseeing the liquidation of their own firm. By 1944, the transition was nearly complete, and the final terms of the takeover were being drafted at Bretton Woods. As the war reached its climax, the British realized they had traded their global dominance for a line of credit they could never hope to repay. By the autumn of 1945, the British government was operating on the financial equivalent of fumes. John Maynard Keynes, the architect of modern macroeconomics, was dispatched to Washington with a mission that was more an act of desperation than a diplomatic negotiation. Keynes arrived with the naive expectation that the United States would provide a grant in aid of roughly $6 billion as a reward for Britain's lonely stand against the Axis powers. He viewed the sacrifice of the British economy as a moral credit that should be settled with American cash. However, the American negotiators, led by Treasury Secretary Fred Vinson, did not trade in the currency of gratitude. They saw a competitor whose bankruptcy offered a chance to finalize a global economic transition. The Americans were about to demonstrate that in the world of high finance, there is no such thing as a free victory. The cognitive dissonance between the two sides was profound and immediate. Keynes argued that a debt-free gift was essential to prevent a total British collapse that would destabilize Europe. The U.S. Treasury countered that any financial assistance must be a commercial loan with strict conditions designed to benefit American exporters. Vinson and his team were acutely aware that the British sterling area was a closed circuit that blocked American goods from reaching millions of consumers. They viewed the British request not as a plea from an ally, but as a leverage point to force the dismantling of imperial trade protections. This was a forensic exploitation of a partner's weakness to ensure the dollar's future supremacy. The British delegation soon realized that the price of American liquidity was the surrender of their economic sovereignty. The final agreement, known as the 1946 Anglo-American Loan, was a masterpiece of predatory lending. Britain received a line of credit worth $3.75 billion at a 2% interest rate, a figure far below what Keynes had deemed necessary for recovery. While the interest rate seemed low, the structural requirements attached to the capital were designed to be lethal. The most aggressive condition was Article 9, which forbade Britain from discriminating against American imports while the loan was active. This effectively stripped London of its ability to manage its own trade balance or protect its domestic industries from American industrial might. But even this loss of control was secondary to the poison pill buried deep within the contract. The ultimate American demand was the immediate convertibility of the British pound. Under the terms of the loan, Britain was required to make the pound exchangeable for U.S. dollars within 1 year of the agreement's ratification. This was a calculated strike against the pound's status as a global reserve currency. The Americans knew that a war-torn Britain lacked the gold and dollar reserves to back such a promise. If every nation holding pounds suddenly demanded dollars instead, the British Treasury would be emptied in a matter of weeks. Despite the obvious risks, the British government felt it had no choice but to accept the terms to avoid immediate domestic starvation. The British delegation signed the agreement, unaware they had just wired a detonator to the foundations of their own currency. The countdown to the convertibility deadline of July 15, 1947, was a period of mounting fiscal dread. Inside the United Kingdom, the economy was failing to transition from wartime production to civilian exports. Rationing was actually tightened after the war ended, with bread being rationed for the first time in 1946. The British public was living through an era of extreme austerity while their government desperately tried to stockpile enough dollars to survive the upcoming currency shift. There was no margin for error and no contingency plan if the market lost confidence. The government was betting the entire future of the empire on the hope that the world would still want to hold British paper. This hope ignored the cold reality that every nation on Earth was starving for American industrial goods that could only be bought with dollars. When the clock struck midnight on July 15th, the floodgates of capital flight opened with a violence that shocked even the most pessimistic observers. Countries like India, Egypt, and Argentina, which held massive amounts of sterling from wartime services, immediately moved to swap their pound for dollars. These nations had no interest in holding the currency of a declining power when they could trade it for the currency of the world, its new industrial titan. The Bank of England became a high-speed exit ramp for global wealth. Within days, the modest reserves provided by the American loan were being liquidated at an unsustainable rate. The British government watched helplessly as their remaining national wealth evaporated into the accounts of foreign central banks. The velocity of the collapse was a testament to the total loss of faith in the British imperial model. In the first week of August 1947 alone, Britain lost over $175 million in gold and dollar reserves. The Americans refused to provide an emergency bridge loan or to waive the convertibility requirement, forcing the British to endure the full weight of the crisis. This was the moment this special relationship was exposed as a convenient fiction for American expansionism. The U.S. was perfectly willing to watch the British economy burn if it meant the final destruction of the sterling trade bloc. By the time the British government finally suspended convertibility on August 20th, the damage was irreversible. The pound had been demoted from a global hegemon to a regional currency in just 6 weeks. The aftermath of the 1947 crisis forced a radical reassessment of what Britain could afford to be. The realization set in that maintaining a global military presence and a vast colonial administration was a fiscal impossibility for a debtor nation. Every garrison in the Middle East and every colonial office in Africa was now seen as a drain on the precious few dollars left in the treasury. Decolonization was no longer a debate about political morality or national self-determination. It was a desperate cost-cutting measure. The British government began to view its overseas possessions as liabilities that needed to be offloaded before the next interest payment was due. This was the beginning of the scuttle, where the empire was dismantled not by choice, but by the cold logic of a balance sheet. The failure of convertibility proved that Britain could no longer dictate the terms of its own economic existence. The nation was now trapped in a cycle of stop-go economics, where every attempt at growth was throttled by a recurring balance of payments crisis. The American loan, which was supposed to be a lifeline, had become a noose that tightened whenever London tried to assert its independence. The British public was forced into a decade of age of austerity, characterized by crumbling infrastructure and a declining standard of living. This was the true cost of the victory in 1945. A permanent reduction in national status, and a subordinate role in a world defined by American capital. The empire was no longer a source of prestige. It was a liquidation sale where the primary creditor was calling in every marker at once. The 1946 loan was not a short-term fix, but a multi-generational amortization schedule that would outlast every politician who signed it. Britain agreed to repay the $3.75 billion in 50 annual installments starting in 1950, effectively turning the British Treasury into a collection agency for the United States government for the next 6 decades. While the 2% interest rate appeared manageable on paper, it functioned as a constant drain on the nation's primary surplus during its most vulnerable recovery period. Every dollar sent to Washington was a dollar not spent on the modernization of British coal mines or the expansion of its failing electrical grid. The empire was now paying a massive subscription fee just to remain a functioning state. This financial weight ensured that any attempt at British industrial renewal would be starved of the necessary capital to compete on the global stage. The British public was working to pay off the cost of a victory that had already been spent. The opportunity cost of this debt was visible in the rusting hulls of the merchant fleet and the decaying rail lines of northern England. As the United States experienced the greatest economic boom in human history, Britain was trapped in a cycle of debt service and chronic industrial stagnation. The capital that should have fueled a British technological revolution was instead recycled back into the American banking system to satisfy the terms of the 1946 agreement. This financial drain ensured that Britain could never reinvest in its domestic economy at a scale necessary to challenge the emerging American or West German industrial giants. Every annual payment served as a reminder of the nation's secondary status in the new global hierarchy. This persistent fiscal pressure eventually forced the government to abandon its most expensive geopolitical ambitions in favor of basic domestic survival. The Suez Crisis of 1956 served as the ultimate stress test for Britain's debt-burdened sovereignty and its remaining imperial pride. When London attempted to protect its interests in the canal through military force, the United States did not respond with diplomacy. It sent a financial ultimatum. President Eisenhower threatened to sell off the U.S. Treasury's massive holdings of British government bonds, a move that would have triggered a total collapse of the pound sterling. This was not a military defeat in the traditional sense, but a margin call on a global scale that London could not meet. Britain was forced to withdraw its forces because it could no longer afford the interest payments on its own existence as a world power. The Suez Incident proved that the British military was merely a subsidiary of American foreign policy, subject to immediate liquidation at the creditor's whim. Even during the aggressive privatization and market reforms of the 1980s, the 1946 loan remained a fixed-line item on the national ledger that could not be ignored. Margaret Thatcher's attempt to restore British prestige through the Falklands War was a brief anomaly in a long-term trend of managed decline and fiscal retreat. The debt continued to accrue interest, surviving the transition from the gold standard to floating exchange rates and the rise of the euro. By the 1990s, the original loan amount was dwarfed by the scale of the modern economy. Yet the symbolic weight of the obligation remained a heavy burden on the national psyche. The British government was still paying for the survival of 1945 well into the era of the internet and globalized finance. This long-term repayment plan ensured that the United States maintained a subtle but persistent leverage over London's fiscal choices for over half a century. On December 29, 2006, the British Treasury finally made a final payment of $83 million to the United States and Canada. This transaction officially closed the books on a debt that had defined the post-war era and dictated the terms of British decline for 61 years. By the time the invoice was settled, the British Empire had long since vanished, replaced by a commonwealth of independent nations and a domestic economy focused on services rather than manufacturing. The total amount repaid was nearly double the original principal when adjusted for interest and the various currency fluctuations of the 20th century. This final wire transfer was the last act of a liquidation process that had begun in the dark days of 1940. The debt was gone, but the global architecture it had purchased was now firmly and permanently in American hands. The most profound outcome of this liquidation was the permanent displacement of the pound sterling by the U.S. dollar as the world's primary medium of exchange. Before the war, the pound was the unchallenged global reserve currency, accounting for the vast majority of international trade settlements and central bank holdings. The American-led Bretton Woods system systematically dismantled this dominance by pegging the world's currencies to a dollar that was backed by the world's largest gold reserve. As Britain struggled with its recurring debt crises, central banks around the world realized that liquidity now resided in New York rather than London. The sterling area did not collapse overnight. It was slowly digested by a dollar-centric trade network that offered more stability and greater capital access. This was a slow-motion replacement of the global operating system that left Britain as a legacy user of a defunct platform. The sterling area's absorption into the American system was a logistical necessity for a bankrupt hegemon that could no longer defend its own currency. To maintain any semblance of international trade, Britain had to align its financial regulations with the requirements of the International Monetary Fund and the World Bank. These institutions were headquartered in Washington and reflected American economic priorities and free market ideologies. British colonial administrators found that their local economies were increasingly tied to the dollar's performance rather than the pound's dwindling influence. The financial infrastructure of the empire was repurposed to serve the needs of the new American-led global order. London was no longer the architect of global finance. but a regional branch office in a much larger firm managed from across the Atlantic. The final audit of the British Empire reveals a story of a hostile takeover executed through the medium of sovereign debt and strategic insolvency. The British did not lose their empire to a superior military force or a more virtuous political system. They lost it because they ran out of cash at a critical moment in history. The United States acted as a predatory creditor, providing the necessary liquidity to win the war while ensuring the terms of the loan would prevent any post-war rivalry. This was a forensic dismantling of a global competitor, where the primary weapons were interest rates, trade clauses, and currency convertibility. The world map was redrawn not by the movement of armies, but by the movement of capital across the Atlantic. The sun finally set on the British Empire because the bank decided it was time to turn off the lights. History is often written as a series of great battles and moral awakenings, but the ledger tells a more honest tale of incentives and leverage. The liquidation of Great Britain serves as a warning that national sovereignty is only as strong as the balance sheet that supports it. Once a nation loses its status as a primary creditor, its geopolitical influence becomes an asset to be managed and eventually liquidated by others. The British experience in the 20th century was a 60-year lesson in the reality of fiscal subordination and the high cost of borrowed time. In the end, the most effective way to conquer an empire is not to invade its territory, but to own its debt. This reality remains the fundamental rule of the global power game in the modern age.